Welcome to the Buffered ETF, guys. Bear markets happen, but so do bull markets. So why not be prepared for both? Buffered funds offer some downside protection and some upside growth potential. They're like ETFs with airbags so that you can get retired, stay retired, and stop stressing over the next market crash. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC-registered investment advisor. All right, welcome back. So we're going to continue with this Bitcoin versus buffered Bitcoin kind of conversation. And we did a great job last episode, I think, of talking about the 100% protection Bitcoin ETF from Calamos, the CBOJ. We didn't go into much depth on the CBXJ and CBTJ. So let's go a little bit deeper on those. We talked about the 100% floor protection, which generally, as we talked about, gross of fees, not including fees and expenses, which could be ETF fees, advisory fees, etc. Over the 1-year outcome period, if you invested day one at the exact price that it came out at and you held it for 1 year, you're going to get, if Bitcoin is down or their target, right? This isn't a guarantee. There's no true, it's not a guarantee like you might see from certain investments or industries out there. This is their best efforts, their target, what they're really trying to get at with how they design these. And over that 1-year outcome period, if you invested $100,000 and the Bitcoin were down 40%, if it performs as hoped, then you'd get your $100,000 back, less any expenses and fees. And if it were up 50% in Bitcoin, and that was you wouldn't get $150,000, you'd get your up to the cap, which we talked about last time over this particular outcome period, started around 11.5%, something like that. So tell us a little bit about the ones that give you a little more upside, but they also have a little more downside risk. So talk about the 90% and the 80% floors.
So I would say there's a group of people out there that, in the news, there's all kinds of, especially when Bitcoin is going higher, Bitcoin gets a lot of attention.
Yes, it does.
Right. So I
remember a couple of years ago when I was looking at Bitcoin and investing in it, and a lot of people had never heard of it, and even people in the office I was in. And then all of a sudden, one day on CNBC, it started showing up on here's the NASDAQ, here's the NASDAQ price, and here's the S&P, and then here's Bitcoin price, and it kept flashing, and I was like, there it is.
Yeah. Yeah.
All
and
right.
So it finally got, enough interest that media says we have people that are interested in it. Right?
Now they talk about it every day.
Every day.
Right or wrong, right? This is not a recommendation. We're not telling you what to buy or not to buy.
But it got people, I would say there's a lot of people that they got their attention because it moved quicker than a lot of investments do, right? You were looking at it going, we haven't seen anything quite like this before. So it got people's interest. And so people wanted to participate. Well, as time goes on, what happened? Well, then we saw big moves in the opposite direction in Bitcoin. That got people's attention. It's like, wow, people have seen drops in the stock market and stuff, but this seemed even, I don't know if it did, but I mean, it seemed quicker and more dramatic than what people probably used to seeing on CNBC or whatever on their investment.
On their typical, more traditional investments.
That's right. And so it got their attention, and it probably brought up with people different emotions. Some were just like, I want to participate in that. And there's other people who was like, I'd like to, but I can't. I don't know when the next time it's going to drop, 20, 30%.
And let's even explore that a little bit. So I've seen some people when it's going up, like you're talking about, who want to add more to whatever they may own. I've seen some people just call and say, hey, I'm excited about this. Should I get in? And others who are like, I just want to learn, right? Yeah. What is this? And then when it goes down, sometimes those people sell, right? So they bought high and they sold low. I've done that at points in my life. And some people who call and they're like, hey, this is probably a good time for me to potentially consider this. What do you think? Right. So people are jumping on, getting out, getting interested, getting uninterested. It may go down. They're like, I'm done. I'm never talking about Bitcoin again. See, I told you. So there's a lot of different viewpoints out there.
There is. And so let me ask you this. So if someone asked you, so Mike, what's going to drive the price of what's got to happen for the price of Bitcoin to go higher?
This is a great question. So let's just talk about some of the factors around Bitcoin, because I think a lot of people listening to this are wanting to learn more about this. And we're not going to do an exhaustive study on Bitcoin. You can continue your studies or just consider this some different thoughts and pros and cons. Again, we're not making recommendations of Bitcoin or any buffered ETFs. We're just teaching, right? We're just bringing education to the market. So some people love Bitcoin. Again, this is not a personal opinion or recommendation. Some people like that Bitcoin is a different asset class. So they like what the word low correlation or uncorrelated. But at times we've seen the correlation be quite high between traditional investments, the stock market, if you will, and Bitcoin, where they go up together and they go down together. But some people still stick to that. And no doubt it is a different asset class, whether it's uncorrelated long-term will remain to be seen. But we've seen gold at times be very highly correlated to the market, and other times it's not correlated to the market.
Correct.
I think this last couple of months when the market pulled back quite a bit, gold went up quite a bit. So they were uncorrelated, but there's other times where you can look back and that's not the case. And then you've got the use case of Bitcoin, how readily it could be accepted as a payment system, as blockchain technology for contracts and the like. Some people may say it's the first market mover. It's certainly the largest cryptocurrency in the world by a huge margin, probably 10 to 1. And so you've got a lot of people saying different things. You could look on CNBC and they do, I think, a great job getting different sides of the equation, where one person will be on there promoting Bitcoin and the next person will be dogging Bitcoin. So what else are you seeing some people say that maybe in their opinion, pros or cons or catalysts for up or for down?
I think it's good to be able to see different opinions and see how things play out. Because I think there's been a lot of, this is a very early, we're in the early stages, I would say, of Bitcoin. It hadn't been around long. I mean, gold, it's been around since the Old Testament. I mean, people put value on gold,
yes.
For a long time.
Way to pull on the biblical example. I love it.
Yeah. And so Bitcoin is still relatively new. And so you'll hear pundits come out and, people do a lot of studies, but they say, okay, because the dollar is getting stronger, that's going to be good for Bitcoin. Well, then the dollar gets weaker and Bitcoin doesn't do what they said. It's like, okay, there must be other variables. So I think there's a lot of variables in there that I think we're still learning. But what we have seen is the acceptance of Bitcoin out of all these cryptocurrencies that have gone. It has grown. If people are honest, we're still learning, and that, as things, it becomes more accepted, people get more comfortable with it.
Isn't that true of social media and big tech companies? That you said this word new a minute ago, and it's a really interesting word because we're still learning about what the next stage and evolution of social media companies is and these big tech companies, right?
Yeah, correct.
So things are constantly changing. It's never like you just get to arrive at a point in this particular stock, for example, and say, now the time has arrived. It's great and safe to get in, and I'm going to have a smooth ride and make a ton of money.
Yeah, there isn't a red light, green light for you, is there, for stocks?
And there can be algorithms and trading charts and techniques, but those are going to potentially fail at some point. I mean, I've never seen one that's perfect on every metric so far.
No.
I don't think they exist or ever will.
Warren Buffett, considered one of the best investors ever, doesn't have a 100% hit rate, right?
Yeah.
I mean,
you mentioned that word new. What's the biggest buzzword in the industry right now? It's actually an acronym or initials. What would it be?
Wow. Now you're putting me on the spot.
Yeah. It has 2 letters. It starts with A and then it has another vowel. AI.
Oh, AI.
Tricked you.
I should have known that.
You're on air. Sometimes you get on air brain and we can't think. Aren't people saying that about AI? And some people are saying, well, it's new, but it's the next thing and it's going to happen and here's blah, blah, blah. And there's other people saying it's so new. It could just be the tech bubble of the late 90s and these companies' valuations don't make sense, right? I mean, new carries both risk and return.
It does.
Scenarios,
I think
right?
that's a great analogy. AI, people much smarter than me that understand.
That's not hard to do.
No, that's right. It's a very low bar. Know the computing power, maybe in how to program, that they could explain to you how AI works and becomes better and learns. But that doesn't mean they've pictured all the applications that are going to be out there for AI.
Do you think a lot of people really understand AI right now?
No, but I think there's a group of people that understand the programming and the computing and have learned the inner workings of AI, just like there is a group of people that have learned a lot about how blockchain works. You hear that word. They understand the mechanics of Bitcoin, but I think we are still learning the applications of Bitcoin, just like we're learning the applications of AI. How this is going to look in the future and how people are going to use it is still unknown. In both those cases, as more applications are found, does that increase or decrease the value longer term of most assets? Typically, it increases the value, right? And that's why people are interested. Does it mean it will? No, it still could not, no, like you always say, we don't know exactly how it's going to go, but typically it increases in value the more applications and uses there are for it.
And things change. So just because something seems great today or whatever, maybe gone tomorrow, I'm thinking through 5G. Yeah, I don't know. What was that? Maybe 6-8 years ago, something like that. Maybe not even that long ago, but I remember people were gearing up and people were trying to buy it as an asset class or as a, focused ETF. And I haven't seen a lot of headway with a lot of those that are just focused on the 5G, but that's just maybe an example where 5G can still win, right? Everybody uses 5G, but how to actually play it. And blockchain and cryptocurrency could still win, but it may not actually end up being Bitcoin, right? It may be, it may not be. And some people, we've talked about some of the pros and some of the cons. And again, this isn't a recommendation, just talking through things. But if you really don't like cryptocurrency or Bitcoin, then you don't need to go any further, or you don't need to, you can talk to your advisor about whether this is right for you or not. But for someone who may be interested in Bitcoin, but they're just not wanting to take on all the risk and all the return, what are some of the other options? We broached on them last episode, but let's go into a little bit more depth as to the 90% floor and 80% floor. Talk to us about how those could work.
For some people who have looked at Bitcoin and said the risk is just downside risk and volatility is just too much for me. I think having now these buffer ETFs bring more groups of people into the camp of now I can tolerate or I'm interested in getting into the Bitcoin space if I have these type of ETFs. So one of them, like you mentioned, it's 90%, which basically you are now risking on an annual basis the first 10% downside, and then there's an 80% of where you're taking on 20% of the risk, and then you can make the decision that am I willing to take that much risk. But on the upside, the more risk that you're willing to take, the caps go up dramatically. So
I got those right now.
Yeah. So tell us what's the most current caps on
the current caps, and there's 231 days left in the outcome period for each of these two that I'm going to talk about. Last episode, we talked about the starting caps for CBOJ, which started a couple months ago, and these started a couple months ago as well, which is why there's not 365 days left on the 1 year outcome period, but 231 days because 150 days or so have already ticked off the clock. So as we talked about, you're going to have some volatility while you hold that during the time, or even if you buy it inter-period. But if you bought it intra-period, the current cap on the 10% risk, the 90% floor. So 90% floor means if you hold it to the end of that outcome period, another 231 days in this scenario, as of the recording of this episode, which is June 13th. And again, this depends on what day you buy it, what current price you buy it at that point in time, et cetera. But at this moment, it has on the 10% one, you have downside risk, or your floor is 85.85%. So it's not the 90%. It's fallen to 85.85% because it's already gone up in value. The current cap allows you to make up to 23.25%. So let's just round off those numbers to make it simpler. You have roughly 15% of the downside risk instead of 10 over the remainder of the outcome period, but you have a little over 23% on the upside. And for the CBTJ, which is the 80% floor, it now has a floor, if you bought it at this particular moment that I'm saying this, 75.07% on the floor and 42.28% on the upside. So as we talked about, the upside is significantly different on the one that offers you not 100% floor, but 80% floor, which at this moment, if you bought it, is only 75% floor. But talk to us about a little bit about that trade-off, and could some people blend these perhaps?
Sure. Yeah, I would think that you can look at this and say the max amount that I want to risk is 10%. So you would maybe just focus on those ETFs that give you that. But you may be looking at it saying, if this thing really takes off, I've seen a lot of pundits say this could really take off. I want to capture more of that upside, and I'm willing to, have a little bit more risk. So just my simple brain is, there's some at 10% floor, risk, and 20. I'd rather be somewhere around 15. You can get both of them, maybe, and blend them to get whatever risk level you're wanting to get to. Because they don't have an ETF, for each. Here's the 10%, here's the 11%, here's the 12%. You can look at them and say, okay, I'm going to buy these and blend it to get to the risk level that I want.
These companies, there's a lot of companies. There's hundreds and hundreds of options of these buffered ETFs out there. And there's a handful of them that are focused on the Bitcoin as the asset class. Most of them are related to the S&P 500 or the NASDAQ or Russell 2000. There's some international ones. There's at least one, I think, that's focused on China. We'll get into a lot of these over the coming of this podcast, but I've seen one recently that has 15%, so an 85% floor for related to Bitcoin, so 15% risk, which is, again, so you can kind of blend these, or someone could do, how do they arrive at 11%? If they said, I want 88, I'm gonna make this number 80. Wasn't 88 from Back to the Future?
It was.
88 miles per hour. I'm Marty, Professor Marty. No, Marty was the kid.
Marty was Michael J. Fox.
Michael J. Fox. Who was?
Doc.
He was great.
Yeah.
I loved him as an actor in that movie. 88 miles per hour.
McFly. Go ahead.
Make like a tree and leave. All right. So we're going back to the 80s there.
There's one thing, though, you brought up that when people are looking at, because you're right, we've talked about Calamos, but there's a lot of different companies putting out buffers. I think it's also to understand, what is the buffer doing? We've just went through and said, hey, you are risking, on a 90%, you're risking 10%. If it goes down more than 10%, you don't experience that loss. There's other buffers that are saying, hey, if it goes down, let's say 15%, you're covered on the first 15%. But if it goes down more,
save that for another episode.
Save it. Save it. Okay, so the only point I'm making is all buffers aren't the same.
There you go. I love it. I love it.
So when you're evaluating these, make sure you understand actually what the buffer is providing, because same word but different, can be different.
Absolutely
implemented differently.
Just like using the word floor or buffer can mean different things to different people.
Yes.
Right. You can say I've got 100% or 90% floor or 90% buffer, and they can mean two different things. Is that, are you protected on the first 10% and you're exposed on the next 90%? Or are you exposed on the first 10% and protected on the next 90%? Right. Yeah. So a lot of varieties, and we're going to get into that. So keep coming back. And it's also important that you study this. You talk to your advisor about this. You call us and have a meeting with us about this, because there are a lot, and it's easy to get confused or not know which one to buy. There's a lot of companies. We're not affiliated with any of them. We don't make any recommendations on this podcast of what you should do or shouldn't do, or should buy or shouldn't buy. We're simply educating. You can talk to your advisor, talk to us. But with these, so let's go back to the 88 miles per hour. So let's say you wanted to create something that had the 88% floor, then you could go and run some numbers and say, and I'm making this number up because I'm not doing the calculator right now, say I'm going to put 54% in this buffered ETF and 46% in this buffered ETF, and arrive at whatever that gets you on the floor and the cap. And you can blend that. I've seen people do that. And kind of like the 88 miles per hour. I love going back to the future. When was that movie? You know?
80s. No, I don't know exact year.
Pick a year, and I'm just going to test you afterwards. I'm going to take a guess too, and then we'll go back and see who's closest.
I'm going to say 1983.
All right. A coffee is on the line. Free coffee in the lobby. But you have to make it if I win, and I'll make it if you win.
Okay.
I'm going to say I was 8 years old. I'm going to go to 1982. Would you say 83?
88.
Okay. I'm going to 82. All right. The barista is on the line.
All right.
All right. All right. So we've talked about this. There's different flavors, different companies who offer, and buying intra-period, which is why it's important that we can go and look at different companies, different products, different times of the year to see what we want. And you can continue holding these. You don't have to just dump it when the outcome period ends, and they don't just automatically just send you your money back and say, we're done. If you want to re-up, you can. What happens when it matures?
It just rolls over again to a new period. So if it's a 1 year period, it'll roll over and there's a new 1 year period.
But you get taxed on it when it matures, right?
Only if you sell it.
Oh, so I can continue holding it and making it tax efficient and getting tax deferral?
Correct. So like many assets, when you buy it and hold it, you don't get taxed on it until you sell it. This is very similar to where when you buy the ETF, the capital gains on it do not get assessed until you sell it. So it's very tax efficient.
Plenty of ETFs or funds or stocks out there may pay, big dividends or distributions along the way. And so you're losing some of that tax efficiency inside of those, but these tend to actually be, and most of them advertise on their websites and literature and stuff as quote unquote tax efficient. It doesn't mean they're perfectly tax efficient and you'll never get taxed a penny, but they're typically designed where with these options and bonds and zero coupons or however the particular company for that particular buffered ETF may structure it, that they tend to be tax efficient. But you need to look at each buffered ETF specifically and find out what that one does. But in general, what I've seen is that they do tend to be pretty darn tax efficient and true to how they advertise. That's
been my experience too. And when I talked about rolling over to a new time period, just remember the cap on it could be different because it's going to be based on the market conditions.
Could be worse.
It could be worse. It could be better. That's right.
But if it got worse and you didn't like it, are you stuck in it?
No, it's very liquid, and you can always make the decision that you want to allocate your capital somewhere else.
Yeah. So far, they have been a liquid. Some point could time when that could dry up as to whether there's a buyer on the other end. But they're an ETF on the market, so they've been very marketable, very liquid so far from most of the ones that we've seen. As a general, not a specific comment to any particular buffer ETF. And if you sell it let's say you were holding it and the outcome came and you didn't like the new cap, you could exit or you could get out that next month. Again, subject to maybe it's priced a little higher. Maybe it's priced a little lower, but it's optionality. I love optionality in life, just knowing that there's kind of entries and exits that you can do in markets. Getting stuck in an investment, it can be hard for people who may do certain investments that you can't get out of that are more illiquid. So I think optionality in these buffered ETFs has been what some people are attracted to.
Absolutely. Would agree.
All right, so we're going to wrap it up on this continued conversation, education on Bitcoin versus buffered Bitcoin ETFs, and I hope you have an incredible and blessed day.
Take care, everybody.
We hope you enjoyed this episode of the Buffered ETF Guys. Please hit that subscribe button so you never miss an episode, and share this podcast with someone who could benefit from it. Check out our blogs, webinars, and other resources at atxfinancialplanning.com. You can easily book a meeting with an advisor at ATX Financial Planning at atxfinancialplanning.com. That's atxfinancialplanning.com. We're headquartered in Austin, but we serve clients from coast to coast. Be on the lookout for our next episode. Stay wealthy by protecting your wealth. All content is for information purposes only and should not be relied upon as individual advice. Investing always involves risk and possible loss of capital. All opinions expressed herein are solely the opinions of the person making them. Participants and clients of ATX Financial Planning and guests of this podcast may maintain positions in the securities discussed in this podcast. Talk to your advisor before acting on anything. Nothing mentioned on this podcast, including specific investments mentioned, should be taken as a recommendation. Advisory services are offered through ATX Financial Planning, LLC, an SEC-registered investment advisor.